Waymo is becoming way more prevalent here in San Francisco. And Travis at Uber had invested a lot of money in self-driving capabilities, and then they had to cut it before it came to fruition. And that may look like the most short-sighted prop the stock up kind of move if 5 years from now Uber's out of business because self-driving Waymo and others have eaten their lunch. And so at some point, you do have to invest in R&D for the future, especially when you have these big shifts. Otherwise, you're just going to get caught on the wrong side.
Is this thing on?
Yesterday's price is not today's price.
As a kid, I used to collect baseball cards. Now I collect benchmarking reports. So when Joe and his crew at Emergence Capital dropped this hot, tasty benchmarking report, I had to get him on the old line to talk through it. This one had everything. I mean, we talk about AI trends and benchmarking the number of companies who are incorporating AI versus like actually making money off it. Not that many. We talk about investing in AI and if you think that the target P&L should change at all as you lean more into R&D. We touch on efficiency metrics. How have they changed? Is the rule of 40 still a cool thing or not? Do people value a growth over profitability? The answer is yes, but the narrative says no. We talk about net dollar retention rates. It was pretty bleak out there, you guys. If you were over 100%, you were looking pretty good. Days of 150% NDR might be gone, at least for a while. And then most importantly, we talk about this concept of the messy middle. There are a lot of companies who have gotten to maybe like 50 million, closing in on 100 million, and they're kind of stuck, right? The growth rate has gone down. They're still burning cash. What will be the exit path for them? Will there be a new type of investor who steps in? Are some of these companies quietly shutting down? We do a little bit of crystal balling on this one as well. It all comes back to fundraising and staying alive. Like, I think a lot of companies out there think that a fundraise is in itself like this major milestone, but it's really just oxygen to keep on fighting another day. And it was really showing up in the metrics. Fundraising has slowed down. It looks like the number of months has gone up by like 30% in between initial rounds. So investors are waiting to see more traction. Founders are trying to take less dilution. And the metrics, it's all a story in the metrics. Retention, net retention, gross retention, growth rate, we talk it all. This and much, much more after a short word from our sponsors. What does the future hold for business? Can someone invent a crystal ball? Until then, over 38,000 businesses, wow, that's a lot of companies, have future-proofed their business with NetSuite by Oracle, the #1 cloud ERP, bringing accounting, financial management, inventory, and HR into one platform. With real-time insights and forecasting, you're able to peer into the future and seize new opportunities. Download the CFO's Guide to AI and Machine Learning for free at netsuite.com/metrics. That's netsuite.com/metrics. METRICS, metrics. Please, guys, I really need this. Annual planning season is upon us. That's right, my favorite time of year. And it's not just about setting goals for the coming year. It's about ensuring you have the right tools in place to measure and achieve those goals. As a SaaS CFO, I know having access to reliable, real-time metrics is crucial for my annual planning process. That's why I'm so excited to partner with today's sponsor, Maxio. Maxio is a billing and financial operations platform that helps subscription businesses reconcile bookings, billings, GAAP revenue, and SaaS metrics automatically. By the way, guys, bookings, billings, GAAP revenue, not the same thing. Got to get them straight. Because these numbers are the foundation of your financial models, it's important to have quick access and trust that they are correct. Don't let the complexities of SaaS finance and accounting slow you down. If you want to start 2025 with the right tools, check out Maxio by visiting maxio.com/run the numbers. That's maxio.com/run the numbers. Request a demo through our link to support the podcast, ya boy, and receive a 10% discount on your first year with Maxio. That's maxio.com/run the numbers. maxio.com/run the numbers. Please, guys, I really need this. Joe, welcome to the pod.
Yeah, thanks for having me.
I've been deep in the weeds on this benchmarking report. Some would call it the benchmarking report of the last month or so. Congrats on getting that out. I imagine it was a lot of work.
It was a ton of work. It's kind of the culmination of over a decade of keeping track of all of our portfolio metrics and seeing value in that, and then wanting to do the same for the community. Not a simple lift though.
No, not a simple lift. So we're going to dive into that report. We're going to talk about some of the takeaways, some of the metrics. People, I can hear them in the background hitting the Nespresso machine to get a cup of coffee out of their Run the Numbers Yeti mug. Can you tell us like how this benchmarking report came about? What like how many people were surveyed? Like why is this statistically significant?
Sure. So we started with our portfolio, which is about 100 companies, all enterprise software companies, primarily, at the Series A. And then we also invited 24 seed firms to participate, and they participated by either sharing a link to their founders who would fill out the survey directly, or simply submitting their portfolio metrics to us directly, anonymized, of course. And then we then aggregated the responses, and we had over 650 responses. So a pretty good cross-section of enterprise software, ranging all the way from pre-seed companies all the way through pre-IPO companies. So a good cross-section.
Nice. And you hit on AI pretty hard up front, which I think everybody wanted to see. And the report showed that a meaningful number of companies are incorporating AI into their products. But to go a level deeper, Joe, are companies actually showing that they're making money off of AI yet, or is that still down the road?
Yeah, it's early. So roughly 60% of the companies surveyed have incorporated Gen AI specifically into their products in some way. And of those 60%, another only 60% are actually finding a way to monetize. And the ways that they're monetizing run the gamut, all the way from, a simple price flat fee to use it, all the way through usage-based pricing. And so it's just early days and people figuring out A, how to generate value, and B, how to monetize that value.
And if your product isn't an AI product per se, like, OpenAI, but it's enabled by AI, I do wonder in the back of my head if incorporating AI, say into like not a legacy product, but let's say like NetSuite incorporates AI into it, or let's say Microsoft Office incorporates AI. How much of the AI incorporation do you think is beta just to like keep up with the market? And how much do you think will change these products fundamentally to like fully set them apart and get that alpha?
Yeah, I think about it as maybe there's two waves. The first wave, a lot of it is going to be, how do we just get something into our product? How do we show some value? And people will have to do it defensively because that's what the market is expecting. And then I think you'll see a second wave of people who take more of an AI first approach or kind of a rethinking of core workflows in an AI first world. And those will be the ones that generate more alpha. Now there's a question, can legacy companies do that? And that's something that we've seen for 20 years. Some can and some can't, but that's what makes this job fun.
And you saw some companies out the gate who had been around for a while, like a GitHub Copilot or something like that. Like they took an existing workflow and made it better. But I think the proof will be in the pudding with a lot of these companies of, is it just like a shiny bell and a whistle that you're putting in, or are you actually changing the way that customers interact with your product?
Well, some things like GitHub, right? They had an unfair data advantage, number one.
Oh, totally. Yeah.
And two, coding also lends itself really, really well to this as I don't want to say simple because it's not simple, but as a good use case for LLMs.
Yeah.
Things that will come that will be more AI native in the future most likely are going to be compound companies that have multiple agents working together or multiple workflows that are made better by AI. And those are the things that we will see in the second wave.
Yeah, well put. And I do think that established companies have a lot to benefit because, like you said, they either have the users to sell it to or to benefit from it, or the data to harness using those large language models. I do wonder, though, like I'm a finance dork and I'm always thinking about the CFO tool stack. I wonder how long it'll take for some of these companies to work better with numbers, because I've been kind of underwhelmed so far with the AI innovations within finance.
Yeah, I mean, different industries, like the future is distributed unevenly, right? So different industries will be impacted at different time frames. You touched on it comes out of data and distribution. And so if a startup can have an advantage in an area where an incumbent doesn't have data or distribution advantage, those are the areas that are probably going to be attacked first. But over time, I expect every piece of software to be remade. in an AI first world.
Joe, I had somebody recently who's going through annual planning right now because it's late August, rolling into September, and they're like, "Hey, should my operating plan and budget change for next year with like an AI, buffer? It's like, should the numbers change and how much we can spend? Do companies get like a break on efficiency metrics at all with this?"
It's an interesting question. I think it's case by case, right? Based on the company and what their specific challenges are, or if they have extra cash, or if they're already efficient or not efficient. I do think that companies that aren't investing at least something in exploring how AI can change their business, they might be okay this year, they might be okay next year, but they're definitely going to be dead in 5 years. So if people aren't investing and thinking about how AI is going to impact their industry, that's going to be a problem.
I like to say though that the P&L doesn't discriminate, that like at the end of the day at scale, you need, plus 25% EBITDA margins or more. Like how you incorporate AI within that P&L is kind of up to you. But you do see some companies even in their earnings saying that, listen, we are more heavily investing in AI. And I think that's going to hit the R&D line. And then at the end of the day, it probably will be some reduced profitability for a while.
Yeah. And I think if you're a long-term shareholder and you believe in that, that makes sense. I was like talking about this yesterday with another investor. Waymo is becoming way more prevalent here in San Francisco. And Travis at Uber had invested a lot of money in self-driving capabilities, and then they had to cut it before it came to fruition. And that may look like the most short-sighted prop the stock up kind of move if 5 years from now Uber's out of business because self-driving Waymo and others have eaten their lunch. And so at some point, you do have to invest in R&D for the future, especially when you have these big shifts. Otherwise, you're just going to get caught on the wrong side.
Oh man, it's like so hard. It's because you can make the right decision at the wrong time, right?
Totally.
Like, is that going to happen in 20 years or is it going to happen in 10? Because if it's happening in 10 years, you should have started investing probably 3 years ago.
So I'm probably more on the edge of it's going to happen way faster than people think.
Really?
There's a great blog post written fully 10 years ago on a website. I think it's called Wait But Why.
Oh yeah.
And it's a fantastic blog post, and it was written 10 years ago, and it's all about how humans are really bad at understanding accelerations, like geometric accelerations, with COVID being kind of an example of it's hard for people to extrapolate how quickly something's going to spread. And if you think about AI, we're in this part of the S-curve where we're rapidly accelerating, and people can't even fathom how much change has happened in a year, let alone in 3 months. And so you just start fast forwarding and you think GPT-4 only came out a year ago. Like how different could things be a year from now? So I'm on the edge of, I'm on the side of things are going to happen a lot faster than people think.
I've also seen like when you see images of I remember once it's this exercise where someone shows a lily pad and they say the lily pad doubles every day. At what point will it be at, like I'm making it up, like 1,000 lily pads and you can't see the pond anymore? And the answer is like in like 8 days because exponential growth goes that fast. But like you said, the human mind is terrible at imagining how fast that really is.
Yep.
I think the saying, Joe, is like we overestimate what we can do in a year, but underestimate what we can do in 10.
Bill Gates said that. I don't know if he was the first one to say it, but I remember he got attributed that quote. I think of it more as humans are really good at comparisons and we're really good at linear extrapolation. But we're not very good at exponential growth or geometric growth, as you mentioned. And we're also really not good at points and like things without a comparison.
Without a comparison, that's funny. Somebody was telling me about this well-known private equity firm who they observed, like from the CFO's perspective, they were excellent at pattern matching of like, oh, you should add payments to this product because we've seen this company, that company, and that company. But like they were bad at picking up on like if they had a right to win in payments and like how the customers interacted within that case. So I do think that like pattern matching is part of it and comparisons is part of it, but sometimes we can get wrapped around the axle when it comes to looking more long term.
Absolutely.
We can get back to the benchmarks in a second, but like I just do want to pause in the exponential growth piece because there are a lot of companies that are coming out right now and you don't really know where it's going to go in 5 years. And there are some companies like OpenAI or Cohere, they're in the news everywhere, right? Like, are these companies still going to be the brand name companies, or do you think we're very early in this where it's going to be a completely different cohort? Like they say, Google was a 17th search engine to market. Like, what do you see here with the companies that are coming out today versus what you think will be the brand names later?
Yeah, it's an interesting question. I took maybe more of a contrarian view a year ago. We published a thesis piece on essentially the rise of open source, and that open source models would eventually outcompete a lot of these closed source models. And I still believe that. I was actually going to originally title the piece "OpenAI is dead, they just don't know it yet," but I thought that was a little too provocative. So I'm backpedaling a little bit from that. I think OpenAI has a great brand. They've clearly gotten a lot of adoption, but I do think all the rest of the closed source models are dead. There's just no reason for them to exist. When Zuck released Llama 3.1, he essentially gave the world $1 billion of R&D that everyone else in the world can use for free. And that model is better than every other closed source model except GPT-4. And what the community has done, like the community is taking these Llama models and they're distilling them, they're model merging them, they're putting them in mixtures of agents models. Like they're going to keep advancing all the edges. And then hopefully Zuck releases, the next Llama a year from now. It's even better. And the same community can just build on it. And it's utterly incredible. So for me, I don't see a world where Mistral or Cohere, quite frankly, exists in 2 years.
Ooh, hot take. This is what people come to the pod for. You heard it here first. Hey, thanks for listening. We'll be right back after a word from our sponsors. Okay, serious question for all my accounting pros here today. Are you doing what you were hired to do? What I mean is, do you have time to actually be a business partner, or are you buried in tedious manual tasks just to get your journal entries prepared every month? I know how that feels. Leapfin's here to help with that. Leapfin is accounting automation software that automatically prepares and posts reliable journal entries. And that's just the beginning. High-growth businesses like Reddit, Canva, and Seeky choose Leapfin to eliminate manual tasks, accelerate month-end close, and enable accounting leaders like you to provide faster insights that will help your company grow. If you're battling messy transaction data from Stripe, Adyen, Shopify, Apple Pay, and other PSPs, and then battling again to get it all into NetSuite, go to leapfin.com to watch their short product intro video. And if you like what you see, request a 15-minute conversation to learn how accounting automation can help you and your team. Check out leapfin.com today. That's leap like jump, fin like shark. I just made that up. I hope they're okay with it. Leapfin.com. Ready to plan confidently, close faster, and report more accurately? Here's what sets Planful apart. Imagine purpose-built applications for every department, from FP&A to accounting, marketing to HR, all with built-in financial intelligence. It's easy to implement Planful in just weeks and with minimal IT involvement, so you can rapidly and seamlessly engage everyone across the business on your key financial progress. Best of all, Planful grows with you. Its unparalleled scalability ensures that no matter how fast your business expands, Planful can keep up. See why over 1,500 customers worldwide choose Planful as their flexible, user-friendly, end-to-end financial performance management platform. Oh yeah! Go to planful.com/metrics to see how you can reach peak financial performance with Planful. That's planful.com/metrics. Mercury knows your financial operations are complex. Founders and finance teams have to pull together different tools, reconcile transactions from different sources, and struggle to get accurate answers. With Mercury, you can simplify your operations with banking and software that power your critical financial workflows, all within the one thing every business needs, a bank account. And with new bill pay and accounting capabilities, you can pay bills faster, stay in control of company spend, and speed up reconciliation. Apply in minutes at Mercury.com and join over 200,000, ambitious startups that trust Mercury to provide the precision, control, and focus they need to transform their financial workflows so they can perform at their best. Mercury, the art of simplified finances. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group and Evolve Bank and Trust. Members FDIC. I'm getting good at that voice. There is a comparison to open source coding development, right? Like, don't they say now like 70 or 80% of anything that's developed came from open source? It's not like you're building something from scratch every time, and it gets better when you have inputs from others.
Yeah, and I think we've seen time and again that open ecosystems generally win over time, and the closed ecosystems generally have an advantage in the beginning because they have speed and they have a head start. And so I think we'll see that play out here.
Yeah. Well, let's get into some of the efficiency metrics, because this is probably my favorite part of the deck. And it seems that investors are valuing growth at 2 to 3x more than profitability, which is like completely contrarian to what you're hearing. Everybody's using these sound bites that like, it's not growth at all costs, and that it's like the age of profitability is back. And we've seen like the lines kind of cross over in the graph of like the regressions of growth versus profitability. But like, is the rule of 40 right? Like, how should we think about that if that's the case, that growth is worth more?
Yeah, I think the rule of 40 is a good heuristic. It's like a good little soundbite for people to keep in their heads that ultimately the market will value you on growth plus profitability. I mean, ultimately, as a finance guy, you probably appreciate this. Like the market values you as a machine that produces cash flows. And so it doesn't really care what you do. It just cares that you produce cash at hopefully an increasing rate. And at least when it comes to tech companies, historically, it's this kind of ratio that growth has been valued more than profitability has been true. It's stuck between 2 and 4x more for growth over the last, call it 10 years. And it's kind of just changed based on what was more in vogue. And I did the regression at kind of going back 10 years and the relationship held. I think right now there's a focus on profitability because running out of cash means you're dead. But there's always going to be this focus on growth because ultimately, if you believe software margins will happen with scale, you just simply need to grow enough to have those margins.
Yeah, it's like rule 1, stay alive, and like profitability or cash is your oxygen. But then again, like you have to grow to eventually have a durable model that's going to spit out cash flows at scale that people want to invest in long term.
You said it better than me.
I'm just drafting off you, man. And the net dollar retention rates from the survey, that I gotta say, like this part was bleak to me. You can correct me if I'm wrong, but like it looks like if you're above 100%, this is net dollar retention, right, guys? So like expansion is in there. You're in good shape. What happened to those days of 150% NDR? Is that gone?
It's gone for now. I would say I was shocked. I had seen a dip in our portfolio, but then when I saw it across 600 plus companies, it became more obvious. 2023 was a hard year for selling software. And so companies that were able to be over 100% NDR were generally speaking in the top quartile, which, I mean, that would have put you in the bottom quartile probably in 2021. So things have changed. I think the number one insight when I dug into the numbers was that it's not necessarily straight churn that's happening. So much of the headwinds for NDR is downgrades. It's companies saying, hey, I may have bought, for example, SalesLoft's an investment I made. I may have bought SalesLoft for 100 sales heads, but now I only have 80. So I need to downgrade 20% of my contract. Or people saying, hey, I bought a usage-based product and my entire market slowed down. I'm not going to hit the bucket of credits that you sold me. I'm either going to churn or you're going to have to give me a refund on 30%. So it's definitely been a headwind.
And just to remind people, like the components that go into net dollar retention rate, like you can have the expansion from existing, and then you can have the contraction, which is either a function of downsell, which is less, but like they're still around, or just churn completely. And to your point, Joe, like if you're not hiring people, you're not buying more licenses. If you're not hitting your revenue targets, maybe you're not, I'm just making it up. Like you don't need as much Snowflake compute because of it. So I don't know. Like I did a total double take on those. Like, whoa, it was tough last year for some of these companies.
Yeah, it was tough. And it was actually such a shocking number for us that we double checked with some of our peer funds to be like, hey, are you seeing the same thing in your portfolio? And it was pretty much universal. So
yeah, I wonder if it gets better at scale though, because some of the NDR rates, at least that they release in the public markets, and it's funny because a lot of public companies have stopped giving you the exact number. Like they won't give you 121%, but they'll say it's above our benchmark of 120%. I do wonder if it gets better at scale and like some of these mid-market companies were hit harder, smaller ones.
Yeah, it's an interesting point. I always think the mid-market got hit the hardest because in many ways they were in that growth at all cost kind of hyper growth phase. And so they were over investing in sales and marketing. And in all likelihood, they kind of got lazy. In 2021 and 2022, people were buying software like it was going out of style, not as focused on ROI, not as focused on tight contracts. And when things shift, they're the ones who feel it the most. And they're also the ones where churn and downgrade can really impact them. And at least the companies in our portfolio that were larger, kind of pre-IPO, many of them have diversified product lines. Many of them have sell to enterprise, so they've got higher ACVs, maybe more core products, and those just experienced less churn.
And I should have called it kind of the mid-stage companies, not mid-market, because that you actually have something to lose then, right? Because if you're a mid-stage company, it means you have revenue, you have customers, and so they can actually downsell and churn, where I think the metrics looked a bit better for the early stage ones because it's like you don't have that much to lose at that point.
Yeah, it's very true. I mean, you can at least hero outgrow the churn you have if you have a small base.
Yeah, you can kind of brute force it to a certain extent. But on the gross dollar retention front, when I was looking at the report, it said subscription-based companies saw 85% compared to 43% for usage-based. My goodness, do you think this is a wake-up call for usage-based companies who thought it was just like all upside?
I don't know if it's a wake-up call in the sense that they need to completely abandon their pricing model, but it does at least make you think that maybe they should have a hybrid pricing model. Maybe they should have some platform fees and then some usage-based. It is really stark when you look at some of the verticals that were really impacted. For example, I'm on the board of a banking software company that has a big mortgage industry component. And mortgages, I think it was down 60 to 70% from the highs in 2021 in terms of mortgage volume. And so the business actually performed very well. But when your customers have that kind of volume decrease, they're not going to upsell.
Right.
And so we were lucky we didn't have a usage-based component, but some of our competitors did, and they got crushed. So the usage-based thing kind of works really well in bull markets, and it doesn't work as well, obviously, in down markets.
That's funny, though, because you can be somewhat insulated by your pricing structure, and it's not necessarily reflective of the end health of the customer.
Yeah. And when those things are not in alignment, though, then you get tough renegotiation conversations.
Do you think a lot of companies are coming around to the realization that hybrid is probably the best of both worlds, where you have some sort of like baseline that you can count on each month, and then above that, you have the ability to overachieve?
I personally like hybrid pricing models. I also feel, for the reasons you just mentioned, but I also feel like with AI, people will need to go to them more because per seat pricing isn't aligned with the value that AI can create. And it's also not really in line with the cost if AI as a software platform simply costs more to run. And so having a usage-based component can make a ton of sense. But I also really like it when the usage-based component is directly tied towards customer value. So for example, and this is maybe not the best example, but Snowflake, the more data you put in, the more compute you run, the more they charge you. In theory, you're getting more value if you're running more compute. You could also say that Snowflake tries to get you to cram every piece of data in there so that it becomes more expensive. So there's that too.
Yeah. It's interesting, that trend between usage and subscription, and eventually it kind of all oscillates to be some blend of both.
Yeah. But for example, if you look at like Salesforce, right? If Salesforce wants to charge per seat pricing, which they've always done historically, and then AI comes along and says, hey, you need 90% less sales reps because we are so much more efficient that we can supercharge your 10%. That's just going to destroy their pricing model.
I was talking about how net dollar retention rate was a bleaker picture than I realized. Was it the same kind of narrative for gross dollar retention rates as well?
I mean, it just depended on what industry you're in and who you sell to. I think selling to mid-sized contracts was tough. So kind of like 50 to 100K ACV was particularly a tough segment to sell. If you were selling bigger contracts, that generally means you were selling to the whole company. It was probably a very considered purchase by the CIO. They didn't churn as much. More divisional contracts, which would kind of be that 50 to 100K or more line of business things, those were tougher.
I'm glad you brought this up because it transitions me to kind of a theme that I observed, and I want to get your perspective on it, that the middle is really messy right now. When it comes to targeting customers by segment, for example, you saw that companies who focus on selling the mid-market versus the two other ends, so SMB or enterprise, they seem to get the largest decline. Why do you think mid-market buyers pull back the purse strings the hardest?
Yeah, I think it's a bit of this, what I was talking about with, if you're selling to enterprise, it's generally speaking a very considered purchase. If you're buying something over 250K, you probably have multiple people that are having to sign off, and that implementation is probably really big and really painful, and therefore it's just stickier. if you're buying something that's 50 to 100K, you probably don't need a CFO to sign off on it. It's probably a line of business leader, or it's maybe even like a team leader. And so they could have made those decisions quickly and then pulled back when they were told, hey, you've got to cut your budget. So I think a lot of it has to do with that. And then with SMB, a lot of it is individual users, and they're just not as scrutinized. I think it's not going to, if your company needs to cut 10% of your budget, they're just not going to care about the $20 somebody spends on Evernote or something.
What I really liked in the report is that you called out that a lot of the stuff, say above $100,000, it could be a NetSuite, it could be Snowflake, it could be your AWS bill. Like that's not going away. You need that to run your business, and that's also why it's so expensive, because it's pervasive throughout. It's considered infrastructure, core infrastructure. It's not going away. And then the like $5,000 thing, like maybe, or $10,000 thing, like Carta, you need to run the business. It's also not going to break the bank. Maybe it's something that's a smaller, like an Evernote. But then these things that are $75,000, $80,000, the CFO is looking at that like, what is this productivity tool over here? Like that's where the scissors come out.
Yeah, and I think we saw a proliferation of those types of software tools. And if you look at like the sales or marketing stack, I mean, sometimes people would have 10 different software layers in it. And I think what you saw is a little bit of consolidation as well, as some of these platforms started offering or bundling like a free or cheap version of some other product in the stack. And when it was time to cut budget, people were saying, okay, well, I'm gonna buy 2 or 3 things from one player and cut the other things, and I'll save money.
Do you think the vendor consolidation thing is real, or is that just a narrative that people put out there?
I think it's real. I think that when times are good, people always want to choose best of breed, and they want to piece things together. And then when times get tough and people can save money by bundling, yeah.
It's like what Vin Diesel says in Fast and Furious. You can have any beer you want as long as it's a Corona.
I didn't know he said that. It reminds me of Henry Ford.
What did Henry Ford say?
He said you can have your Model T in any color you want as long as it's black.
There we go. Everybody's consolidating to Salesforce. But Joe, talk to me about companies in the 5 million to 20 million ARR range, because there are a lot of listeners who find themselves at companies there. How are they hit in terms of growth?
I mean, that bucket in particular was hit pretty severely in terms of growth. I think on average, it went from 51% year-over-year growth to 14% year-over-year growth. There's a couple of takeaways. One is the data there is a little messy. So primarily of the 650 plus companies, 500 of those data points came from seed investor portfolios. And so there is some survivorship bias that companies that made it there, it's not the same as looking at a cross section of like Series B companies where you're investing when they're already at between 5 and 20.
Oh, like they already survived long enough.
Right. So there's a little bit of a challenge there, but when I think about it, I think the biggest thing to think about is it is pretty natural that companies hit a wall between 5 and 20, because it's pretty easy to hero sell your way to kind of really product market fit, scaling to $5 million. Generally, people can do with brute force. But if you don't have real product market fit and real market pull, it's really hard to continue that growth. And you find that a lot of like paid acquisition channels that might be really hacky and work really well in the beginning just stop working, or you become saturated. And so there has always been naturally a tendency to have some slowdown in that range. And the companies that can power right through it are usually the ones that can make it to 100. But we always talk about the SaaS wall, which is kind of in that 20 million range. Yeah, I'll give you one example in our portfolio. We invested in Gusto really early. And I remember talking with Josh, the CEO, who's just an absolutely wonderful human and brilliant. And he was really focused on paid marketing in the very beginning. And they had a really efficient SEM campaign, and they were growing really nicely. And I remember in diligence, we looked at the total addressable market for keywords that he was bidding on. And I was like, there's no way that this growth is going to scale if you don't figure out other things. Like, it works at 1 million to grow from 1 to 4, but going from 4 to 20, like, it's just never going to work. And of course, like, you hit that wall, and then of course he and his team figured out other channels to grow. But what gets you there is not going to be what gets you to the next thing.
And there are diminishing returns on anything, like, it could be paid marketing spend. It could be like one guy over in Israel selling to all of Europe or something. Like, that's not going to scale forever. As an investor, what are like and we're going to generalize here, what are like the walls that SaaS companies hit? Like, is it what do you see? Like 5 million and 15 million is really hard?
Maybe rephrase it as like, what are the engines of growth that they have to figure out? And this is kind of generalized, but this is a framework I've been thinking about. So generally speaking, like one product is going to get you pretty far, but you eventually need to become multi-product. And that transition happens usually somewhere around 50 of ARR.
50, okay.
Like, so Viva Systems, for example, kind of CRM powered them to the first 100, and then they had to release Vault, and now they have 19 different products, right? Or it's probably more than 19 now. The other thing that people have to figure out is the distribution side. Like direct selling can only get you so far. The companies that really figure it out generally have either figured out some sort of channel partnership strategy, or some other leveraged way of going to market. And so those are the two big shifts. And sometimes one happens before the other, but generally speaking, those are the two big shifts that happen.
I like how you phrased it as like what you're bringing to market and what your platform looks like. Because I have heard it generalized in the other way, like more along the terms of like, holy shit, you guys blew right through 20 million. A lot of companies get hung up at 15 and you just kept going. And it's almost like there are these mile markers along the way that people are aware of. But to your point, you can bring that back to like, where are you in terms of product market fit? Where are you in terms of having different sales engines spun up?
Yeah. And the other piece of it is people. Like, somebody, I don't remember who, but told me about like this theory in the army of how like you can only really have a certain number of people in a unit, and then like the next unit is like a squadron, or I don't know the exact terminology, but like there's certain size limits to the amount of that a team can function in a really cohesive way. And I think that's kind of why people settle around like you can really only have 7 or 8 direct reports, and after that it kind of breaks, and so you get the kind of these structures. But companies feel the same way. Like you get to a certain critical mass of people, and then efficiency starts going down. And some companies figure out how to build those processes and make those companies remain efficient, and some don't.
Yeah, that's an amazing point there. There seems to be this glut of companies in like the 50 million to 250 million ARR range when I looked at the survey, who saw this huge deceleration in growth. So maybe they were over 100% year-over-year growth, and now they're like 30%, 20%, or even like growing backwards. That really stood out to me. And they still aren't profitable though. That's the hardest part. Like if growth comes down, okay, that sucks. But if you're also not profitable at that size, is there like a bifurcation? Like, am I making up that kind of glut of companies, or did you see it as well?
It's definitely there, and it is really challenging. So what happened is a lot of these companies were given free money in 2021 and 2022 at insane valuations. And in order to grow into those valuations, investors said, grow at all costs. Like, we don't care if you're burning $3 for every dollar, like just do it. And so these companies, not to say that they were lazy, but they just weren't efficient, right? Like they just kind of had a lot of fat. And so they were trying to grow as quickly as possible. They were hiring as quickly as possible. And there were also, a lot of these companies went remote during COVID. And so there's some efficiency challenges there. And so all of a sudden you're seeing that as soon as downgrades started hitting the base, or churn started hitting, or they were missing their growth, new bookings plans, you're seeing the growth fall. And then you're also seeing them struggle to get to profitability because they're just so big. And it's really hard to cut an organization in half. It's just not possible, like without culturally doing a lot of damage. And so what you're seeing is like people did multiple rounds of layoffs to try to like trim 10, 15% and then see what the organization looked like. And then 6 months later doing another 10 or 15% because they didn't realize the growth was still decelerating. And everybody tells you, like, measure twice, cut once, like you only want to do one riff. Guess what? It didn't happen. Like over the last 12 to 18 months, every company that went through riffs, I'm not going to say every, that's an unfair characterization, but most of the companies that went through riffs wind up doing 2 or 3. And they're still trying to get to profitability. And obviously the lucky ones already are, but it's a challenge. And these companies know they're never going to fundraise again on those terms that they got in 2021 or 2022. So they're either going to have to grow longer to get there, or they're going to have to find a home. And so for most of them, they're thinking, I'm going to control my own destiny. I'm going to cut my burn and be able to grow long enough to get there.
But like, what happens to them? Because like that's a good plan, but eventually you do get the profitability. Maybe it's years in the future, but a lot of them have timelines because they took money. I mean, they would be too big for most companies to acquire at a price that they'd want, but they're also like too big to wind down. I mean, are they too big to wind down? You can't just like shut the doors.
Well, I mean, I think companies are shutting down quietly. Like,
Are they?
we don't see it splashed around on the news, but Carta just released a report and it said something like 600 companies had quietly closed in Q1 of this year. I'll have to go look for it again, but the number was astonishingly high, and like they have the data because they know which companies basically or cap tables are shutting down. And it's significantly higher than it's been in years past. And I expect that to stay elevated.
Yeah. I think I'll fully understand or realize that once I see a brand name company that I saw take a really big round that is at like 200 million in revenue actually shut down. I just kind of wonder what happens to these companies. Like, is there an emergence of a new type of like a Thoma Bravo or a Vista equity type investor that comes along and tries to make something of these? Is there going to be a new category of investor that tries to turn these around?
I'm not sure you'll see that. So to address the first point though, there was a company that was backed by Andreessen, raised at $1 billion, and they just shut the doors. And that was in TechCrunch the last month or so. So it is happening. And that was big enough news for them to talk about. Like TruePill got acquired this morning at half of their last round price. And so like you're going to see more of those things as companies realize that the valuations weren't real and they have to kind of accept reality. As far as like the Thoma Bravos and Vistas of the world, like look, Vista's really good at what they do. What they do is generally speaking public companies and much larger scale. Like I don't think they have an interest in kind of this middle that may not be working. There are mid-market private equity funds, but they generally don't pay the prices that these software companies would want. And so there's still like a market that needs to develop where people need to come a little bit more to reality. And some of these mid-market private equity firms are probably also going to have to stretch.
Yeah. I think there's a dearth of companies that are like 75 million to 150 million in ARR. And they were all being told by investment bankers 2 years ago that they're going to IPO within the next 18 months. Now it's a pretty sobering reality.
Yeah. And if you're not growing, you're not going to make it out. So you're caught between a rock and a hard place. Like I need to cut burn to be profitable, but I can't grow.
But I can't grow either. That's the hardest part. Like you can maybe make up if one lever is gone, but both of them, you definitely feel stuck.
Yeah, it's hard. And what do you do? What do you do when you're an employee at one of these companies? Like,
well, I'm glad you brought that up. Actually, yeah. What do you do? Because that's probably some people listening right now. They may be looking at it like, listen, I can only invest in one place. Investors that they're lucky to have a portfolio of say 12 companies in it, but this is the only company in my portfolio right now. What do I do here? Do I cut my losses and move on? And that does take somewhat of a sobering financial outlook of what's going to happen here.
Yeah, it's tough, and it's something we struggle with at a lot of companies. And so a lot of companies did repricings of option grants, trying to lower the price to reflect a new reality. And I think that's successful in retaining folks. Folks are also doing just additional grants for their high performers to try to keep them. But it's a question, especially when you can go to NVIDIA. You could have gone to NVIDIA 2 years ago.
Yeah, right.
and been a multimillionaire. So.
And I could have bought Bitcoin in 2012. Oh, well. There is like an inefficiency though in the market with there being companies who are just kind of there. They're not doing much, the zombie companies, because they are like bidding up keywords on Google, or they are, have a bunch of BDRs who are flooding the inbox of a CFO and taking up his time. Like, do you ever think about that impact on just like the economy at large when there are companies out there who really aren't going to, make it to where they thought they were going to be, but they just keep existing?
I've not really thought about that, like zombie companies and how they impact the economy. They definitely, in the startup landscape though, they definitely take up mind share. So if you think about 10 years ago when we were investing in categories, there'd be like 3 companies going after an obvious category, and you'd have to pick between 3, and they'd be duking it out for customers with just those 3. And now you'll have like 10 or 12 in every category, and they are beating each other up, and they're bidding on the same keywords, hiring the same talent. And there's only a finite universe of those things. So one thought is maybe it makes you stronger. The person who emerges is just that much stronger.
Right. You've been through enough knife fights.
Yeah. Or it just means that everyone kind of suffers. Like, I don't know.
Yeah. Yeah. And this isn't me saying this should be like an anti-competitive environment, but you do wonder, like we said before, top talent being locked up at a place that's not really, they have to find a way by hook or by crook out of it.
Yeah. By the way, I did invest in Bitcoin in 2012, and then I sold it in 2014, so it didn't do anything for me.
Well, you got half the equation right.
Yeah.
When it comes to fundraising, I mean, the investments, like just in terms of the sheer quantum, have declined since 2021. But I do think that there's this misconception that it's completely driven by companies just not being good enough to invest in. I still think there are good companies out there. Can you maybe just explain for listeners a bit of the inside baseball of like the mechanics of how the LP-GP relationship may work, and maybe how returning capital could be a factor in all of this?
Yeah, I mean, investments in software companies is directly correlated to the amount of money that was raised. Like it is as simple as that. And so in 2021, I think that was the peak for LPs investing in venture funds. And that was essentially driven by the prior 10 years of a bull market in tech where returns were fantastic. And so it's kind of a lagging indicator that then LPs start piling in. And then when they do that, there's a lot more investment in startups, which 2021 was a peak, 2022 was a little bit down, but still great. And now you're starting to see that there's so much competition, there's so many things being invested in that returns are probably going to be bad going forward, and thus people pull back. And so in that pullback of investing in VC funds, there's simply going to be less capital to invest in startups, and the cycle continues. So I like to think of the universe of investable startups as fairly finite in terms of the number of great teams, great ideas, great opportunities. It's pretty finite year to year. And so it really just comes down to, if LPs are putting more money in, then there'll be more startups being, receiving capital. And so it's kind of the opposite of what you would think, but that's the reality.
Is there any truth to the concept that a lot of these, let's say it's like CalPERS or a big pension fund, they have making up 50 million earmarked for fund XYZ, and they're waiting actually to get that money back so they can put it into or recycle back into that fund's that firm's next fund, and that's also why there's been a slowdown in investments in companies?
That might be true for smaller LPs. For bigger LPs, that isn't a challenge. What's maybe a bigger challenge, which we saw what people call the Denominator Effect, which is if public markets crash 20%, then all of a sudden your private investments look like a much larger percentage of your endowment.
Oh,
and
I never thought of that.
Yeah, and they have like percentage targets. So like maybe someone says, I only want to have 10% exposure to venture. But if Publix was 30% and it falls 20%, all of a sudden venture's now 12% or 13%. And then they might actually want to cut back on fund investments to try to get that to be balanced. So we see that. But most of the large LP community, the fact that money hasn't come back maybe in the time frame they thought it would isn't going to necessarily impact their next commitment.
Related to what you were saying, Joe, would you say that what's kind of the gap in duration between like something happening in the public markets, which are often used as a proxy or comparison for the private markets? Is it the same amount of time it takes for it to be reflected in private markets when something in the public market goes up versus down? Like does the good news or valuation tailwind happen in private markets faster than it takes for bad news to catalyze?
I think private markets lag. They lag a little bit. I also think that they're insulated a little bit because you don't have to report your numbers publicly like every quarter. And so things just kind of hide a little bit longer. So everything just takes a little bit longer to work its way through.
Yeah. Being an operator, though, I mean, I've done it. I've also seen people do it. It's like when the markets are really good and you're talking to potential investors, like you're the first one to say that Palantir is trading at 25x or something like that, but you're not as quick to say, well, CrowdStrike just lost 20 billion off its market cap yesterday because X, Y, and Z.
Yeah, that's true.
And the duration between early stage rounds, it seems like it's getting longer. So it looked like it went from about 19 months to 25. How much of this do you think is founders just saying, hey, listen, I'm just going to wait longer to raise my first fund and basically try to build something with as little dilution as possible?
I think it's two things. One, I think founders are having to get a little bit more proof points than they had in the past. And therefore it just needs more, you need more time to grow into those proof points. And if you raised a I don't know, if you raised a safe round at like a 25 or 30 cap in 2021, in order to actually raise a price round above that, you have to get to like 2 million of ARR, and maybe that takes you 6 months or 12 months longer than you originally forecast. And the second thing is VC funds were really aggressive in 21 and 22 in preempting. And so you'd see funds that had raised a seed 6 months later getting preempted for an A. And that's not happening anymore. And so I think that has also meant, well, okay, outside of AI, that's not happening anymore. And as a result, I think the duration is longer.
I have heard some founders anecdotally saying, and I don't know if they're actually going to be able to live up to this, is listen, man, like I'll never get to the stage where I need like a series E or F. Like I'm going about this trying to build, a P&L that'll like get me to where I want to go with like 2 rounds less of dilution. Do you think that's a mindset at all?
I think people talk about it more. And I do think that there's people talking about how there will be AI startups that only have, 20 people and never need the 500 people anymore. And that could be a really interesting dynamic for the industry. Mostly what I say is raising capital is a means to an end. And so if it accomplishes the end that you're trying to accomplish faster or better, then you should do it. And if it doesn't, don't do it. I honestly feel like most companies probably shouldn't be raising venture, but it's an incredibly useful tool for the ones that leverage it appropriately. And for the ones that don't, it generally speaking isn't necessarily the best thing to do.
Say more about that. Why shouldn't all companies want to raise venture?
Let's say you're in a hyper competitive market and capital can be the difference in moving faster or capturing a flywheel that's going to help you win that market, generating a network effect, like if you're Facebook or LinkedIn. Raise venture capital. Like that's what it's there for. It's there to accelerate, to get to a position where you win a market. If you're in a non-competitive market, or if you're in a market that can't support a venture style outcome, then I probably wouldn't raise venture, because you, quite frankly, won't generate the returns that are going to excite both parties, and it will just become an albatross to have raised $100 million if your outcome isn't going to be great.
And that is a good point and an honest assessment from a guy who is selling cash, and is investing in companies. Like it's not for everybody.
So I have like this funny little anecdote, which is like Aaron Levy at Box. We invested early in Box. Fantastic company. He raised a lot of venture, and he had to, because it was heavy investment in storage in order to be able to sell cloud storage. So he wound up at the IPO owning something like 4 or 5%. It's in the S1, right? It's public information. And so based on like $1 billion outcome, he made like $40 or $50 million. And I also had a friend who was bootstrapped and, owned 90% of his business and just had some friends and families in, and he sold for like 60 million and they made the same amount of money. Right. And they're both equally like 10 years of plodding away to get there. One is not better than the other. They're the same. And so it's just a question of what is the right thing for your particular business and what's going to help you win. Now, obviously, Aaron did extremely well as an angel investor, and Box has continued to do very well. So, that worked out great for him. So, not trying to be pejorative at all in any way, shape, or form. He had to raise the venture money he needed to raise to be successful. So,
it's funny. Would you rather 100% of $100 million outcome, or would you rather 10% of $1 billion outcome? It's all the same. Depends on how you get there in the path.
Well, I could tell you I'd probably prefer the one that didn't have 10 annoying investors on my board.
Yeah, me and you both. Just kidding. What are you working on these days? This report was awesome, but I know you do so much more.
Yeah. So outside of investing, which is obviously the core job, I'm really excited about something we're releasing in a couple of months. So 5 years ago, I released something called the Secret Playbook, and it was the kind of the tips and tricks and secrets that Emergence had accumulated over 20 years and how to help companies fundraise. And we had let our internal founders kind of use some of this knowledge, and we decided 5 years ago to publish it in the form of like an investor CRM. So kind of the universe of 300 or 400 plus investors who invest in the space, sortable by their stage, by their target, et cetera. A pitch deck template, a data deck template. So just some great tools. And we're launching a refresh of that in October, and it's going to be awesome. So Wendy Liu, who's a principal here at the firm, she was a director of AI engineering at Airtable prior. And so she's taking what I released as a pretty janky Google sheet. She's turning the investor CRM into a kind of AI enabled product that people can basically put in their company and have it suggest based on your stage, based on what you do, like who's the right investor universe. And then you can tweak it, obviously, based on, hey, maybe the AI got it wrong, or maybe you want to add people or whatever. And it kind of generates that target list for you. So just as an exercise that every entrepreneur goes through every time they want to fundraise, who should I talk to? You know, do they have a competitive investment already? Should I rule them out? Do they do the right stage? Are they in the right location? Like stop wasting time on that. We can build something for you that'll hopefully just automate that.
That's sweet. Yeah, that's a lot of value there. Shoot me the link and I'll put it in the newsletter and shoot it out to everybody.
2 more months. Give me two more months to get it GA.
Come on, man. Let's go. These dev cycles. We gotta speed them up. Hey, thanks for joining me. This has been a lot of fun. Whenever I can jam out on SaaS metrics, I get very eager and excited.
Awesome. Well, I'm glad I could join you, CJ. Thanks.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.